All right, everybody. Who's jamming with Leonid and Friends? How about that for the intro? No more elevator music. Did everybody like that? I hope. It's one of my all-time favorite songs ever by Earth, Wind, and Fire. And then my friends, the Russian band, recreated that. So love it, love it, love it. How's everybody doing? Happy Friday, everybody. It is 100% summer trade right now. Okay. The only thing that's left today, honestly, is the Russell reconstitution, which we talked about. I think we talked about either earlier this week or last week. The Russell reconstitution, which towards the end of the day today, there will be a lot of volume that hits the tape. Not sure there's really going to be much for us to do, but there will be a lot of volume at the end of the day today. But full on summer trade. In fact, Dan O'Brien, our futures coach and trader, was just telling me right now, the volume today is just absolutely feeble, pathetic. All right. So, what are we going to do today? First, you're all going to hit that smash button or smash the like button, whatever it is. And you're going to subscribe. You're going to do that all for us, right? Excellent. Excellent. Thank you. Thank you. And then today, it is our Friday, end of the month, although the end of the month is actually Monday trade. But we are going to do a pop quiz today. Hopefully everybody is ready. Get your thinking caps on. There will be prizes, swag for every question that we have. All right, everybody ready here? Get your thinking caps on, because today's challenge, we are going to cover extrinsic value, reward to risk, impact of Vega, and then break evens. Okay, get your pen and paper ready. Okay, give me a quick shout out if you're all ready for number one. No, you didn't fail yet. You didn't fail yet. All right. First one, extrinsic value. Okay, here is the scenario. Stock is trading 98.5. If your position is this broken wing call butterfly, so the 98, 103, 105. Okay, that's the position. The trade price is $1.60. How much extrinsic value, how much premium is priced into this trade? Mike, have you ever seen them in person, Mike? Look at these answers coming through. They're all the same also. But Mike Cook, have you ever seen him in person? Wow, everybody's the same. Okay, that is great. The answer is indeed $1.10. So the winner, swag winner for this one, which will make you ineligible for the rest of them, is Bill. Bill 8575. Nicely done. Nicely done. Does everybody understand? Obviously, those that already responded, you obviously understand how to calculate the $1.10. Does anybody here not understand how to calculate the $1.10? Everybody good with that? You don't. Okay, good. Fair enough. So the way that we want to look at this is if this position was on and it was expiration, okay? If it was expiration and the stock is 98.5 at expiration, how much would each position be worth? Well, the only position here that would have any value would be the 98 call, whose intrinsic value at that time would be 50 cents. The 103 calls would be worthless. The 105 call would be worthless. So if the intrinsic value is 50 cents on the 98 and the trade price was $1.60, that leaves $1.10 for the amount of extrinsic value. That help you out? You understand that? Okay. All right, Bill, congrats. Let's go on to number 2 here. Reward to risk. Reward to risk. Okay. Everything up here on the screen is what you need. It's another broken wing butterfly spread. Okay, the 312.5, 322.5, 325. We paid $2.25. The question is, on a worst case basis, what is the reward to risk here? Kevin, what's RM's? Oh, Rocky Mountain Chainsaw. Got it. Mike, you ever want to go to a concert, you let me know. Get you backstage with them. They're on a break right now. They just had 60 concerts. They're on a break right now till mid-August. But you let me know. Where do you live, Mike? See if they're going to be coming by you in the fall. Okay, no tricking. I'm not trying to trick you here, everybody. Okay, lots of answers up there. Gonna wait just another minute or so. I have not seen a correct answer yet. Not asking what the max loss is. We're asking what is the reward to risk on a worst case basis. Worst case basis, not meaning that the stock is below 312.5 at expiration and it's worth 0, because then there would be no reward. All right, how do we figure this out? How do we figure this out? Okay, so if it, David, that's pretty close. That's not exact, but that's pretty close. So as David just said, what happens if the stock blows through the top end here. Okay, stock goes to 328, 330, 350, 400, 1,000. Doesn't matter. Okay, doesn't matter. If the stock is above, no, David, that's not true. That's not true. If the stock is above 325, what will we have at expiration? Well, we will have the long part of the position will max out at 10 bucks. The short part of the position will max out at 250, but that's against us. So the net value of the position would be $7.50. Does everybody see that? Does everybody see? If we blow through that top strike there, does everybody see the value would be 750? Okay. That's the first thing we have to figure out. So if 750 is a worst case on the upside, if we take 750 divided by our 2.25 risk, what do we get? And excuse me, not 750. Not 750, my bad. 750 minus 2.25. So it's actually 5.25 divided by 2.25, which equals 2.33 to 1. David Budd, that was correct what you just said. The 7.5 minus the 2.25. So does everybody see this? Now, if I would have said, what is the reward to risk, not at a worst case, what is the reward to risk here? Well, we would have looked at it and said, well, this thing could be worth 10 bucks, right? So 10 minus our 2.25 is 775. That would put us at 3 to 1 reward to risk. Okay, everybody got that one? We're going to call that one a draw. No winners on that one. No winners on that one. All right, before we get into the next one, let's get to Thor. And our word of the day, which is quiz. Quiz is our word of the day. Give it another minute here. All right. Let's get back. Vega. Now we're going to move into Vega here. Okay, you got a stock price in Google of 175. The August 15th expiration 180 strike call trading for $6.50. Okay. The current implied volatility for that option is 33%. And the Vega is 25 cents. So we've got two questions on this one. The first one is, if the implied volatility increases to 41%, what will that do to the value of this option? The second one is if implied vol decreases to 28%, what will that do to the value of that option? Okay, 2 questions there for it. Okay, any more answers here? Okay, come on, I'll give you guys another. Everybody has the tools here to be able to figure this out. I want to wait for a few more answers to see if we can get some here. Just saying up or down doesn't make a difference. I want to know the new value of this option. Okay, how do we figure this one out? So if the implied volatility goes from 33 to 41, that's a gain of 8. For every 1 percentage point that the implied volatility moves, the value of the option will change by a quarter, which is the vega. So if we have a quarter times 8, that equals a change of $2. Does everybody see that? That change of $2 would then make the value of this option $8.50. Let's see if we got the first $8.50 up here. A lot of rays. Bear, you are the first $8.50. Nicely done, Bear. Okay, does everybody see how the math works on this? Now, on the downside, if we're going from 33 down to 28, that's a decrease of 5 points, a quarter for each point. That means a decrease of $1.25, which would put the new value at $5.25. Let's see who the first $5.25 answer was besides Bear. Okay, Bear and Bill, who already won, you guys got that, so you're out. Thomas Swift, you got it. You won earlier in the week. You're out. Any other 5 1/4s? RDB. Just put that up there. Does everybody follow how we figure this out? Kevin, you're just a nanosecond too late there. Does everybody understand how to calculate the value of an option when implied volatility changes? Okay, very, very important to understand. That's why we track where implied volatility is so closely when we put a position on. All right, let's get to some break evens here. Okay, let's get to some break evens. Broadcom trading 270. This is an iron condor position. Okay, selling this iron condor at $4.10. Where are the break even prices in the stock at expiration? IV is not, well, in terms of Kevin, just like Delta measures the amount of change in the value of an option or the value of a position as the stock moves $1, Vega is how much the value of an option changes when implied volatility moves 1 point. Easy one to remember with Vega and implied vol. You've got V and V, Vega vol, Vega vol. Okay. Okay, where are our break evens on this? You are welcome, Kevin. For those that have not entered in yet, Thor says quiz. Rocky Mountain Chainsaw, that is a great answer. It's not the right answer because we need definitive numbers, but that's a great answer. I like it. Okay, anybody else besides Bear? Anybody else besides Bear? This one seems to be some trouble here. All right, Jake Jacobson, you are the first one with both correct answers after Bill. Bill can't win again. So let's take a look. How do we figure this out? Well, if we take our short option, our short put, 267.50 less the $4.10 credit, that means our break even on the downside would be 263.40. Does everybody understand that? And before I go into the upside break even, last call for the wheel. Thor's word today is quiz. Okay, back to the upside. Take our short option, 272.5. add in the $4.10, and we get 276.60. Everybody understand that? So anywhere in between those 2 points on this position, and this would be a winning position at expiration. Okay. Everybody squared up with this one? Robert DB, I don't see your answer to this question above there. Exactly right, Kevin. Subtract on the short, add on the long. Well, Kevin, seems like a good trade. The reward to risk on it is fantastic. The problem or the question is we have to look to see what the actual expected move would be, which since AVGO is sitting right at 270, we can look live right now. So let's take a look at this. Okay, with AVGO at 270, what is the expected move going out to next week? The expected move is right about $8.50. So that would put us to 261.5 on the downside, 278.5 on the upside. Those are the numbers, those are the ranges that we would like to see the break even points come in. Okay, so 261.50, 278.50. We are not that that far away to the downside or to the upside. So even though the reward to risk on what you see on the screen here is great, the probabilities are not with us because of the expected move. Robert, I see the comment from Rocky Mountain. I do not see your response anywhere near there in the chat. All right, guys, before we go to the wheel, and this has to be a quick answer because I don't want anybody to Google this one. I don't want anybody trying to find out the answer to this one unless you already know it. Where and when was the first form of options trading used? Does anybody know this? If you know this, boy, that'll blow my mind if you know this. A long time ago. Chicago, those are good answers. Dutch, Greece. David Budd, you just looked that up, huh? That is correct. David is correct. The answer is ancient Greece, 6th century. And this Greek philosopher used option contracts to speculate on the olive harvest. Good one, good one, good one. All right, everybody. It is time. Let me see if we got the wheel ready to go. Yes, we do. Yes, we do. Oh, we got a nice wheel today. All right. All right. So if you are one of the winners in our pop quiz today, you are not eligible on the wheel. Got to try and spread the love around here a little bit. Those of you that already won something from the quiz today, make sure you shoot me an email with your swag size and a delivery address. But right now, let's get the wheel rolling here. And Connie Yank, are you Connie Yank, in the house still? Connie Yank, are you still with us? I know you were in the room all morning, and I know you were in here earlier. Boom. Nicely done, sir. Nicely done. Shoot me an email. All of the winners today. It is now up on the board here. Prosper Swag at prospertrading.com. All right, everybody. Hope this was helpful. Don't forget, next week is a shortened week. Everything is moved up a day because the markets are closed next Friday for July 4th. So not only does that mean that expiration is on Thursday, it also means that all of the big eco data that normally would have been on Friday, including which will be the June jobs report, will actually come out on Thursday. All right, everybody. Appreciate all of you. Have a fantastic weekend. Make sure you get those emails to me. We'll see you on Monday, everybody.